All right, let's talk about what is quite possibly the most critical skill in all of valuation, estimating cash flows. I mean, if you get this part right, you're pretty much golden. But if you get it wrong, well, let's just say it's not pretty. Yeah, that's a pretty bold statement, right? It's from valuation expert Aswath Damodaran, and he's not mincing words. Look, everybody loves to geek out over discount rates and betas, but the real battlefield, the place where valuation truly succeeds or fails, is in the cash flow projections. So that's what we're going to do right now. We're going to break down the professional's playbook for getting these numbers right. We'll look at the common traps people fall into and figure out how to accurately estimate a company's real underlying cash-generating power. Okay, first things first, let's really dig in and pinpoint the problem we're here to solve. Where does all the focus usually go and, where should it be going? It's kind of wild when you see where analysts actually spend their time. A huge, massive amount of energy goes into tweaking and perfecting the discount rate. But like we just said, the real mistakes, the ones that can completely sink a valuation, they're almost always hiding in the cash flow numbers.
So how do we fix this? Well, the good news is we can actually build a clear, repeatable roadmap to get through this whole process, making sure we don't miss a single crucial step.
And here it is, our map. It's a really powerful 4-step framework. We're going to start with the earnings the accountants give us, but here's the key. We're going to fix them. Then we'll handle the taxes, pull out the money the company plows back in for future growth, and what we have left, that's the prize. That's the free cash flow to the firm. All right, step 1. This is absolutely huge because our starting point, those accounting earnings, well, they're often a pretty flawed picture of what's really going on. So this section is all about how we fix that picture. We've got to make 3 big adjustments right out of the gate. First, always use the most recent data you can get your hands on, the trailing 12 months, not last year's annual report. Second, if you're looking at a cyclical company, you got to smooth out those big swings to find what a normal year looks like. But the third one? This is where the real magic happens. We need to fix how accountants categorize some major expenses. So let's dive into the first big one, operating leases. Just think about a retailer like The Gap for a second. Almost every single one of their stores is leased. That creates these massive, long-term financial commitments that they absolutely have to pay. Now here's the disconnect. An accountant looks at that lease payment and says, yep, that's an operating expense, just like the electricity bill. But the financial reality? It's completely different. A long-term contract that you must pay is, for all intents and purposes, a form of debt. It's a fixed claim on your cash. And once you make that switch, once you start treating these leases like debt, which is a process called capitalizing them, it sets off this whole chain reaction. 1, the company's total debt just skyrockets on paper. 2, its operating income actually goes up because that lease payment isn't an operating expense anymore. And 3, and this is critical, its return on invested capital usually drops, which gives you a much more honest look at how profitable the business really is. Okay, what's the next big accounting rule we need to fix? Research and development, or R&D. So accountants expense R&D in the same year the money is spent. But think about it. Does any company spend millions or even billions on R&D expecting it to only pay off for 1 year? No way. It's an investment in the future. It's a capital investment. And believe it or not, turning that expense into an asset is a pretty simple 3-step process. First, you just have to estimate how long that R&D is going to give the company an edge. Then you gather up all the R&D spending from that time period. And finally, you can calculate the value of this new R&D asset and figure out how much of it gets used up or amortized this year. Now, you might be thinking, okay, is this just some academic exercise? Absolutely not. For a company that's heavy on research, like the biotech firm Amgen, this changes everything. Treating R&D as the investment it truly is boosts its estimated value per share from $43 all the way up to $74. That's a nearly 75% increase, a massive difference, and it all comes from fixing just one accounting rule. Okay, so we've corrected our starting earnings number. That was the heavy lifting. Now we can basically fly through the rest of the map. Let's knock out the next 2 steps, taxes and reinvestment. So, when it comes to figuring out the taxes on our shiny new operating income, you've got a choice to make. The effective tax rate, what the company actually paid, that's a decent starting point for the next few years. But for the long haul, you have to shift your thinking toward the marginal tax rate. That's the tax rate on the very next dollar of income, and it's a much better guess for the future.
And reinvestment? Well, that's also not as simple as it looks on the surface. For a company like Cisco that literally grows by buying other companies, you have to include all that money spent on acquisitions. That's a real cost of growth. And for working capital, which is basically the cash tied up in day-to-day operations, we want to pull out cash and short-term debt to get a cleaner number.
Okay, let's zoom out. We've gone through all of these details, all of these adjustments. What's the big picture? What's the main thing you should walk away with after all this work? The bottom line is this: you just can't take an accounting statement at face value. Ever. You have to put on your financial detective hat, look past the surface, and really understand the economic reality of the business you're looking at. You have to adjust for the real nature of leases and R&D and other commitments to find the real cash flow. And that leaves you with one final critical question, a question you have to ask yourself on every single valuation you do from here on out. Are you valuing the company's accounting, or are you valuing its reality? Because the difference between those two answers, well, it's everything.